Hey, good morning, everyone. Marty Mazzora here, Wednesday, 9th of November, 2022, with your midweek market snapshot, stock market snapshot. Going to keep it simple again this morning and just show you the weekly, the daily, and the hourly charts on the S&P 500. I'm sure I'll talk a little bit along the way about recent events. In front of you is the weekly chart. It's a 3-year weekly chart and pretty much the same pattern we were looking at the last time. We have a falling wedge pattern, which is bullish, particularly when it's coupled with divergences. We have a lower low here and we have a higher low on the moving average convergence divergence, or the MACD, and the relative strength index, or the RSI. Sure enough, broke out of the downtrend, found resistance at the 20-week moving average and continued to battle that there. Came back, tested the downtrend line and passed the test so far, although we're struggling this morning. The S&P, as I speak, is down a little less than 1%, and we're about an hour and a half into the market session here on Wednesday. So still on net bullish look. And we do have back our nascent buy signal on the weekly MACD, and that's the red line dropping below the white line there. If we were to come back down and break through this, which we very well could, this rolls over, can get pretty ugly below here. So right now, though, I'd say on net, the weekly longer-term chart still looks constructive. The one-year daily chart on net still looks constructive as well. Right now we are battling with the 50-day moving average, which sits at 3791.97 to be exact, and the S&P right now is trading right on that dot. And this is a delayed chart, so I'm looking at another screen that gives me real-time quotes or real-time data. And so, as I said last time, we need to really make a momentum-filled move above the 50-day moving average and back above this 38.2 retracement of the recent decline. Really constructive looking 20-day moving average. Remember, we've tracked this thing back a ways, and when you break through that with some momentum, as we did, and we had some very bullish engulfing candle action in here twice, upward sloping, that looks good. If the 50-day continues to flatten out, that looks good as well. Things look okay down here. Again, it was a really bullish setup across the board down here. We talked about that down at these levels. Right now, maybe not as much. Failed right at that 50% retracement, which you can expect. And recall, I said that we've got kind of a brick wall here at 3,900. On Fridays, the last technical update I did for you, I said 3,800 was going to pose some pretty stiff resistance, and sure enough, it is right here. And of course, we have a lot of uncertainty this week. We had midterm elections last night, still a few races to be determined. Wall Street chatter was that a resounding win by the Republicans would be resoundingly bullish. But more than anything else, they kind of say that, at the end of the day, gridlock is good. And it doesn't look like it's going to be this resounding Republican victory, other than in the House, but the Democrats may keep control of the Senate. Historically, when you look at that mix, the market tends to do pretty well. This notion that gridlock is a good thing, believe me, I subscribe to that notion. This is just the way I think about politics and economics. However, in the real world, if we do end up in recession, and remember our base case is that we will over the next few months, although we believe that it will be mild by historical standards if indeed we're right and we do see a recession. During recessionary periods, markets anticipate and expect, and I want to say, I guess, in quotes, need fiscal attention. So the idea, going back to John Maynard Keynes' theories, when the economy suffers, government's job is to step in and try to fill the gap in terms of what we lost by way of aggregate demand. So consumer pulls in, government steps in, because obviously there's a gap when the consumer's not hitting the stores and doing the internet shopping and so on. So if you have gridlock, particularly when you come in with a platform that says we're going to impose some restraints on this runaway spending and all this inflation and so forth, well then might make it kind of difficult to come up with some fiscal relief. At least that's what I think the market's going to fear. And what I just mentioned really speaks to the bullishness, right, of putting a restraint on big fiscal spending coming into the economy and creating more inflation. Thing is, the fiscal spending that's been approved has been approved and it's there. And I don't know that we were going to get a bunch next year anyway, in addition to what's already slated in terms of infrastructure spending and so on. So again, the risk, though, I think would be we get into some trouble economically, and the government, and this would be a risk to markets, and the government doesn't swoop in and kind of, with some fiscal relief. Although you still do have the Fed, and we're going to go into that recession, if indeed it does occur, with, when we're talking certainly recent history, high interest rates, much higher than people have grown accustomed to over the last 40 years. And we've gotten here very, very quickly. So to the extent that government may not come to the rescue during the next recession or the forthcoming recession, again, that's a big if still. But remember, we staked out months and months ago a 3,500 bottom for the S&P. We said that's where we think this bear market bottoms, and we would expect to, if we're right, back up the truck and get more aggressive. Well, we didn't do that because when we made that call, we were not signaling, or our work was not signaling recession looming as it is now. So in a recession, basically what we should expect is that the next leg down would be inspired by pull-in from the consumer, disappointing corporate earnings, and so on, because the first part of this is arguably just the discounting and valuations based on higher interest rates, which makes perfect sense. But now if we follow that up with real ugly, recession era earnings, well then market should go lower. However, there's a tailwind, right? If the economy does roll over, inflation's going to roll over at least to some degree, probably a large degree with it coming off of these levels. And therefore interest rates are going to come down, and that's going to be a tailwind for stocks. So while our base case still has to be that we ultimately, pierce these lows, I'm not sure it'll be, a 2008 style situation. We do think there is the potential, though, for some breaks, that there may be some whales out there in the surf that are very leveraged against, say, fixed income in some dimension. And if that were to break, that could be akin to, like Lehman event. We had some rumblings or some real panicky stuff go on in the UK in recent weeks that impacted our markets. So we're going to continue to hedge that risk with some out-of-the-money S&P 500 options, try to keep them as cheap as we can. And just to mitigate something like that, just in case it occurs, we do think that risk is above zero right here as well. So again, that's your daily look. Still constructive, kind of the jury's still out. Have CPI tomorrow, and that could be a big mover of stock prices in the short run. And lastly, we'll take a peek at the hourly chart. Remember, we were looking at this rising wedge pattern against really dramatic bearish divergences, and it was just, that was a high conviction call that we were going to come out of here and begun to bounce. We began to bottom here. We had bullish divergences and we bounced. And I said we could see some resistance at 3,800. Actually shot through that. But as we did, we developed a very definite rising wedge pattern, although we really didn't have any bearish divergences just yet. So broke out below that, wrestling with that level right there. As I speak, we're at 37.92. So we'll see. I think the market's going to be kind of range bound today. And I think right now the focus is more about CPI than it is what's left in terms of determination relative to the midterm elections. So again, on the weekly chart, the daily chart, relatively constructive. Short term, if I were a short-term trader, I might be right here. You actually break down below there, it gives you a green light to go short. But I think it's a dangerous play right here. If I were a short-term trader, I'd go very light in this market and wait for tomorrow and see the market's reaction to that. But that's not what we do here on behalf of clients. We're long-term thinkers. We're pretty excited about our 5-year outlook based on the changes that we're seeing in the world, inflationary backdrop, where governments are going to be spending money going forward, and where in the world they're going to be extracting the resources necessary to meet their ambitions. So folks, I'll leave it there for now. You'll have the end of week technical snapshot will come your way on Friday. And of course, every day we'll do the morning note. And I hope you have a good rest of the day. Thank you for watching and listening as always. Take care.